Last time, this channel told you Canadian aluminum tariffs have pushed prices up 58% inside the United States, a number Mark Carney himself used to answer Trump calling Canada's leadership nasty. That number wasn't an estimate or a talking point. It has a name attached to it, several names, and a dollar figure specific enough to show up on a public earnings call. Molson Coors, one of the largest brewers in America, just told investors this exact tariff is costing the company somewhere north of $125 million this year alone. And it's not the only American company saying so on the record in public filings. If you've been watching this channel's coverage of Section 232, the Steelworkers Letter, or Carney's 58% number, this is the video that shows you exactly whose pocket that money is actually coming out of. Subscribe before we get into it, because by the end of this, you'll know precisely which American companies, which American workers, and which American products are quietly absorbing the cost of a tariff that was supposed to punish Canada. And drop a comment when you're done. When a tariff's real cost shows up on a beer company's earnings call instead of a government ledger, who does that tariff actually punish? Let's get into it. Quick recap for anyone catching up, because the mechanics matter here. This channel has already covered how Section 232 tariffs on Canadian steel and aluminum got doubled around the same period American steelworkers wrote to Washington asking the administration to back off Canada specifically. On June 1st, 2026, the administration went further, signing a new proclamation that restructured how these metal tariffs actually work. A 50% tariff on goods made almost entirely of aluminum, steel, or copper, and a lower 25% rate for what the policy calls derivative products, goods only substantially made from those metals, not solid blocks of the raw material itself. That distinction, full rate versus derivative rate, is about to matter a lot more than it sounds like it should. Here's the mechanism behind Carney's 58% number, in plain terms. American manufacturers who need aluminum don't just pay whatever the global commodity price is. They pay that price plus something called the Midwest Premium, a regional surcharge that reflects how much extra it costs to actually get metal delivered and available inside the United States specifically. Tariffs on the biggest supplier of that metal don't just tax imports at the border, they distort the entire regional price because every domestic buyer is now bidding against a smaller effective supply. That premium has surged roughly 300% since these tariffs escalated. Midwest aluminum prices have been sitting around $4,800 a metric ton, an all-time high. That's the 58% numbers engine room, not an abstraction, a specific regional price mechanism with a specific company already telling investors exactly what it costs them. Molson Coors put a number on it first, and it's worth sitting with. Chief Financial Officer Tracy Joubert told investors the company is now facing an incremental headwind of $125 million in 2026, specifically tied to that Midwest premium spike, later revised upward past $130 million as the year went on. The second quarter alone absorbed $40 million of that. Joubert's guidance told investors this cost is significant enough on its own to shave 9 to 10 percentage points off the company's pre-tax income growth this year. Put plainly, one American brewer is telling its own shareholders that a single regional aluminum price surge is worth roughly a full percentage point of profit growth every month for an entire fiscal year. That's not staying inside a boardroom. Molson Coors has told investors it now expects overall profit to fall somewhere between 11 and 15% in 2026, with the aluminum cost surge named specifically as a primary driver. And it's changing real decisions on the ground, not just the balance sheet. Multiple American beer producers are now reportedly leaning back toward glass bottles instead of aluminum cans, reversing a decade-long industry shift toward cans that was originally driven by cost and recyclability. When a packaging material becomes expensive enough to make a company reconsider its entire container strategy, that's not a rounding error. That's a tariff actively reshaping how a major American industry does business. Can manufacturers themselves try to get relief and were turned down flat? Scott Breen, president of the Can Manufacturers Institute, the trade group representing the companies that actually stamp the metal into cans, formally requested that filled food and beverage cans be added to that lower rate derivatives category this year, the 25% tier instead of the 50% tier. The request, in Breen's own description, was completely denied. Updated tariff rules took effect April 7, 2026, and cans stayed exactly where they were, on the expensive side of that line the June proclamation drew. Breen's public position afterward was blunt. The current structure keeps American can manufacturers competing at a real disadvantage against foreign-filled cans that never cross this particular tariff line at all, undercutting the same domestic industry the tariff was supposedly designed to protect. It isn't only aluminum squeezing can makers either, which is part of why Breen's frustration reads as more than routine lobbying. The Can Manufacturers Institute has separately noted its members rely on trading partners for roughly 80% of the tin mill steel used to make can ends and tabs, meaning a domestic can producer can get hit on two separate metal tariffs at once: the aluminum body of the can and the steel components that seal it, while a fully assembled, pre-filled can imported from a country outside this specific tariff structure walks through the door facing neither charge. That's the exact competitive imbalance Breen was pointing at. Not that tariffs exist, but that the way this one is drawn manages to burden the domestic manufacturer more than some of the foreign competition it was supposedly designed to protect against. Ball Corporation, one of the two companies that make most of the aluminum cans in America, gave the clearest window into what happens next. The cost gets passed straight through. Ball has been raising prices to its North American customers by as much as 30%, adding roughly 2 cents to the cost of manufacturing every single beverage can produce domestically. 2 cents sounds small until you remember Americans buy tens of billions of aluminum cans and bottles every year, at which point 2 cents a can becomes a real board-level number fast. Ball's response has been to accelerate construction of its own $4 billion domestic aluminum smelter in Oklahoma, an attempt to route around the tariff entirely by producing more metal on U.S. soil. That relief isn't close. The facility isn't expected to meaningfully come online until late in the year at the earliest, which means for most of 2026, Ball is simply eating the cost, same as everyone else in this story. Crown Holdings, the other major American can maker, has told investors much the same thing in less specific terms, confirming aluminum costs are up significantly without yet putting Ball's precise numbers on it publicly. Between them, Ball and Crown make the overwhelming majority of the aluminum cans sold in the United States, which means when both companies are independently telling investors the same story on the same earnings cycle, that's not one company's isolated cost problem. That's the entire domestic can manufacturing industry absorbing the same hit at the same time, from two competitors who normally have every incentive to undercut each other's pricing rather than confirm each other's bad news. This isn't actually the first time this exact playbook has run, which is worth knowing because it tells you how this usually ends. The last time Section 232 aluminum tariffs were in effect, between March 2018 and August 2022, independent research the Beer Institute commissioned found the U.S. beverage industry alone paid $1.714 billion in tariff-related costs. Here's the detail that should genuinely surprise you. Only about 7% of that, roughly $120 million, actually reached the U.S. Treasury as tariff revenue. The other 93%, close to $1.6 billion, went to U.S. rolling mills, U.S. smelters, and explicitly named in that same research Canadian smelters, as elevated prices flowing through the supply chain rather than as government revenue at all. Read that again. A meaningful share of the money American brewers paid because of a tariff aimed at Canada ended up as higher realized revenue for the Canadian producers that tariff was supposed to be squeezing. Automakers are absorbing an even larger version of the same math. General Motors alone is projecting up to $3.5 billion in duty costs for 2026, driven primarily by Section 232 levies on steel and aluminum. Across the three major Detroit automakers, General Motors, Ford, and Stellantis, combined tariff-related costs hit $6.5 billion in 2025. And all three companies told investors during their first quarter reports this year that they expect material costs to climb further, a combined $5 billion higher than they'd originally budgeted for. Per vehicle, aluminum alone has added more than $1,000 to production cost since 2024, on top of separate steel-related increases, in an industry where a single vehicle already carries somewhere between 500 and 800 pounds of aluminum, more in electric models built around lighter frames specifically to offset battery weight. Stack the aluminum and steel tariff impact together on a single vehicle, and independent estimates put the combined added cost somewhere between $1,600 and $2,000, which is exactly why destination fees, the flat charge added to every new vehicle regardless of trim, hit record highs on 2026 models, with full-size GM and Ford trucks and SUVs carrying a destination fee of $2,795. Manufacturers rarely announce a tariff pass-through as its own line item on a window sticker. They fold it into fees and destination charges that read as routine, which is exactly why most car buyers absorbing this cost have no idea a Canadian metal tariff is sitting inside the number. It's worth being precise about where this money actually goes, because it isn't uniformly one-directional. General Motors has also told investors it expects roughly $500 million back in tariff refunds this year, a reminder that the system includes exemption and drawback mechanisms alongside the raw duty costs, and that the largest automakers have entire teams dedicated to clawing back as much of this cost as the rules allow. That refund is real, and it's also a fraction of the multi-billion-dollar totals these same companies are reporting as net cost, not a sign the burden is somehow balancing out. Here's the detail that makes this land differently than a spreadsheet line item. Ford's F-150, the best-selling vehicle in America, assembled at plants in Dearborn and Kansas City, marketed explicitly on being American-built, still runs directly into this tariff, because its aluminum body panels rely in part on imported metal that can trigger the same duty regardless of where final assembly happens. A truck built, welded, and painted on American soil, sold under an unmistakably American badge, still has its actual production cost shaped by a tariff aimed at a foreign supplier. That's not a loophole anyone designed on purpose. It's just what happens when a modern supply chain and a blunt tariff instrument collide. And it's exactly the same cross-border part problem this channel already traced through the auto sector back when covering the steelworkers' letter. Beer cans and truck panels are just the two most quotable examples, not the whole picture. Aluminum shows up in aircraft fuselages and interior components, in the siding, window frames, and roofing on new residential and commercial construction, in the wiring and electrical infrastructure that goes into anything built in the last decade, and in consumer electronics housings by the billions of units. None of those industries have put a single headline dollar figure on this the way Molson Coors or GM have, but every one of them buys metal off the same Midwest premium curve, which means every one of them is quietly absorbing some version of the same cost spike, just without an earnings call loud enough for a single number to make the news. Now here's where Canada's actual position in all of this gets interesting. And it isn't the picture a simple tariff hurts Canada framing would predict. Canada operates 10 primary aluminum smelters, 9 of them in Quebec, 1 in Kitimat, British Columbia, running largely on hydroelectric power that makes Canadian aluminum some of the lowest carbon, most cost-competitive metal in the world, regardless of any tariff sitting on top of it. The Kitimat smelter alone represents billions of dollars of modernization investment, completed specifically to keep that single British Columbia facility globally competitive on cost and emissions. The kind of long-horizon industrial bet that doesn't reverse itself because of a tariff announced in a single presidential term. Before this round of tariffs escalated, the United States absorbed 95% of Quebec's aluminum exports in the first quarter of 2025 alone, about as concentrated a single customer relationship as a major export industry can have. After the tariffs hit, that share dropped to 78% by the second quarter. Not because Quebec's smelters slowed down, but because they found other buyers. Despite losing a meaningful slice of their largest customer, Quebec's smelters have kept running at close to 95% capacity, with no reported layoffs tied to the shift. Aluminum is a globally traded commodity. Cutting off one buyer at a discount doesn't shut down a smelter. It just redirects the metal somewhere else at a comparable price, while the buyer who cut themselves off keeps paying more for whatever they still need to import. That's the part of this story that actually explains why Canada, in the negotiations this channel already covered around the nasty exchange, is pushing so specifically for aluminum and steel to be included in any broader deal on all strategic sectors, not treated as a side issue. It isn't Canada begging for relief from a tariff that's crushing its own industry. The Quebec numbers above don't support that read at all. It's Canada calmly pointing out, with real leverage behind it, that the tariff isn't actually accomplishing what it was sold as accomplishing. It's mostly just taxing American breweries, American can makers, and American automakers, while Canadian smelters adjust their customer list and keep the lights on. None of this means the story is fully settled in Canada's favor, and this channel isn't going to pretend it is. Ball's $4 billion Oklahoma smelter, if it comes online successfully, is a real long-term bet on reducing exactly this kind of exposure. And if enough American capacity gets built, some of Canada's current leverage erodes over time, just slower than any single earnings call suggests. The 7% of tariff revenue that does reach the U.S. Treasury is still real money the government collects, even if it's a small fraction of the total cost. And nothing here changes the fact that, as of this recording, no formal relief on Section 232 steel and aluminum tariffs has actually been signed. The same open question this channel flagged after the nasty exchange still stands heading into August 19th. So here's what to actually watch from here. First, watch Molson Coors, Ball, and GM's next earnings calls specifically, since all three are now on the record with concrete 2026 cost estimates that will either prove out or get revised, giving a real quarterly scorecard on who's actually absorbing this tariff. Second, watch whether the tariff quota proposal for steel and aluminum this channel already covered actually gets finalized before the deadline, since that's the one mechanism currently on the table that could change this math directly. Third, watch Quebec's export numbers specifically, since a continued drift away from the 78% mark would be the clearest sign yet that Canadian producers are treating the U.S. market as less essential than it used to be, a genuinely different kind of leverage than a government press release. And fourth, watch whether any of these American companies start passing costs to consumers more aggressively rather than absorbing them quietly, since a six-pack or a new truck getting visibly more expensive is the moment this stops being an earnings call story and starts being a kitchen table one. Because that's really what this comes down to for you, wherever you're watching from. If you buy beer in aluminum cans in the United States, you're already funding part of Molson Coors' $130 million headwind, whether you've ever read an earnings transcript or not. If you're shopping for a new truck or SUV, you're paying into the same $1,000 plus per vehicle aluminum premium every major domestic automaker has now confirmed on the record. If you work in aerospace, construction, or electronics manufacturing anywhere in the U.S. supply chain, you're paying a version of this same cost too, even without a company earnings call putting a number on your specific corner of it. And if you're a Quebec aluminum worker, the story looks completely different. Your plant is still running at near full capacity because the metal you make doesn't actually need the American market as badly as the tariff assumed it would. So here's the actual scoreboard, stated as plainly as the numbers allow. A tariff built to pressure Canadian aluminum producers is, so far, mostly showing up as cost on American earnings calls, $125 million at one brewer, up to $3.5 billion at one automaker, 2 cents added to every can, 30% added to entire product lines. While the Canadian smelters this tariff targeted have kept their capacity, found new customers, and avoided the layoffs a tariff like this is supposed to cause on the other side of the border. That's not a coincidence, and by now, on this channel, it's the same pattern you've already seen play out in the Steelworkers letter, in the Keystone Pipeline signature, and in Carney's 58% answer to being called nasty. If you want the version of this trade war that follows the actual money instead of the actual noise, that's exactly why this channel exists. Subscribe and get that comment in. When the tariff bill lands on an American beer company's balance sheet instead of a Canadian smelter's, whose tariff is it really? Let me know what you think, and I'll see you in the next one.